Picking back up where we left off, this is the cost of goods sold section, and this is actually a schedule outside of the income statement. And you begin with your beginning inventory. You take your merchandise inventory on the first day of the year, and then you would add any purchases that were made during the period, subtract any purchase returns and allowances and purchase discounts, and that will give you net purchases. And then you would add any freight costs that you had or freight in, and that would give you the cost of merchandise purchased. You add that to your beginning inventory, and that gives you the merchandise available for sale. And then we simply subtract the ending inventory, and that gives us the cost of goods sold. Our selling expenses are expenses that are incurred directly in selling the merchandise. That would be sales salaries, store supplies used, depreciation of store equipment, delivery expense, and advertising expense. So we take our expenses and we break them into two broad categories: the selling expenses and the general administrative or general expenses. And those are expenses that are incurred in the administration or general operation of the business. That would be office salaries, depreciation of office equipment, office supplies. All those would be your administrative expenses. We also have other income and other expense. Other income for Net Solutions would be that little rental income. Remember, it wasn't part of his business, but it's just some supplemental income that they had. So other income is revenue from sources other than the primary operating activity of the business. Other expense is any expense that cannot be traced directly to the normal operations of the business. So let's take a look at our income statement again. And you can see we have our sales less the returns and allowances, less the discounts, giving us our net sales. And then we subtract out our cost of goods sold from the little schedule that we use to determine our cost of goods sold, and that gives us our gross profit. And then we take our expenses and break them into selling expenses and administrative expenses, and that gives us our total operating expenses, and that gives us income from operations. And then we add the other income and then subtract the other expense, and that gives us a net income of $75,400. And now we're going to take a look at example exercise 6-2, and this is on page 257 in your book. And it says, based on this data, determine the cost of merchandise sold for May, and it says use the format shown in the exhibit. So let's take a look at our exhibit. Well, we're going to start that exhibit with our merchandise inventory on May 31st, and then we'll add our purchases, less the returns and allowances, less discounts, plus the freight in. That'll give us our merchandise available for sale, and then subtract the merchandise inventory at the May 31st, 142,000. So this is what our schedule looks like. Merchandise inventory May 1st, $121,200. Purchases of $985,000, less purchase returns and allowances of $23,500, less purchase discounts $21,000, giving us net purchases of $940,500. And then add the freight in or transportation in, $11,300. So that gives us a cost of merchandise purchased for the period of $951,800, and add that to the beginning inventory, and it gives us $1,073,000 worth of merchandise available for sale. And then we subtract the ending inventory on May 31st of $142,000, and that gives us a cost of goods sold of $931,000. An alternative form of income statement is called the single step income statement, and we're going to take a look at that now. So we take our income statement, we take our revenues from all sources. We got our net sales, and then our rent revenue giving us our total revenues. And then for our expenses, we subtract out the cost of goods sold, the selling expenses, the administrative expenses, the interest expense, and we get our total expenses, and when we subtract that from the net sales, or total revenues, I'm sorry, we get our net income, $75,400. And then from that, you remember, after we do the income statement, we do the statement of owner's equity, and it looks exactly the same whether it's a merchandising business or a service business. You start with your beginning capital. So Chris Clark's beginning capital was $153,800. The income for the year was $75,400. Chris made $18,000 worth of withdrawals, giving him an increase in the owner's equity of $57,400. And when we add that to the beginning capital, we get an ending capital on December 31st, Chris Clark capital, $211,200. And then our balance sheet is pretty much the same as it was in the previous chapters. This is a classified balance sheet, so we have different sections. We take our assets, we break them out into the current assets. That's things that are cash or cash equivalents, things that will be converted to cash within 1 year, 360 days or less, 365 days or less. That's our current assets. And then we take and add our property, plant, and equipment, which is our land, our buildings, our equipment, less the depreciation associated with those items, giving us the total property, plant, and equipment. And we add that together and get total assets of $261,560. And then we go to our liabilities, and we break that out like we did our assets. We break it out between current liabilities and long-term liabilities. We have current liabilities of $30,360, long-term liabilities of $20,000, giving us total liabilities of $50,360. And then we add that to Chris Clark's capital, which came from our statement of owner's equity, $211,200. And that gives us total liabilities and owner's equity of $261,560. Now we're going to describe and illustrate the accounting for merchandising transactions. And we're going to include sale of merchandise, purchase of merchandise, freight, sales taxes, trade discounts, and discuss the dual nature of merchandise transactions. First, we're going to take a look at our chart of accounts. And Net Solutions, when they became a merchandising business, we had to add quite a few accounts, and we'll look at those real quick. Under our current assets, we have a new account called merchandise inventory. You would never buy more than a year's worth of inventory at a time, not normally. So that would be a current asset called merchandise inventory. Under our revenues, we have sales, and then we have sales returns and allowances, and sales discounts. So we don't just have fees earned. We've got an account called sales, and then sales returns and allowances, and sales discounts. And then under cost and expenses, we had to add an account called cost of merchandise sold, and we also had to add an account called delivery expense to cover our freight in. So those are just a few of the accounts that we would add if we have a merchandising business. Our sales, recording of our sales for cash looks exactly the same as it would be if we were running a service business. The only thing changes is the account. Instead of revenue or fees earned, it's now called sales. So we debit our cash, $1,800, and credit our sales for $1,800. Now, if we're using a perpetual inventory system, each time we make a sale, the cost of goods sold for that merchandise is deducted at that time. So you can see if we're using a perpetual inventory system and that merchandise sold in that previous transaction was $1,200, we would debit merchandise sold, $1,200, and credit inventory, $1,200. Every time we purchase something for sale, we would debit the inventory account, and every time we make a sale, we would debit cost of goods sold and credit merchandise inventory. If we're using credit cards, we do have fees associated with those credit cards, and we would, anytime those fees are recognized, we would debit the credit card expense and credit our cash. And that normally takes place when you get your statement from the credit card company. And we're going to have to stop at this point because my 10 minutes is up, and we'll pick back up at this point when we start back up. Thanks, and I hope you're having a great day.